Let's talk about bubbles and manias. What this is showing you is that in 2021, there was a mania that spread throughout the market in a way where upside call skew was got very inverted, right? Inverted means that typical shape for skew, which is downside puts are very in demand and upside calls tend to be suppressed and compressed by call selling and the fact that things tend to not crash to the upside. That is your typical structure for the market, not for Bitcoin, not for gold, some other things, but for most stocks, that is really the kind of sort of skew structure that you see. What happened in 2021 is that not just in speculative crazy stocks, we started to see this spread into 35% of S&P 100 stocks. So big companies, the mania spread into people being very exuberant and wanting to buy those upside calls. And they got very excited. Some of it is going to be covering short stock positions. You're buying upside calls to do that. But a lot of it is just everyone FOMOing and getting involved and wanting to take part in this. And that manifested itself in extreme excitement and upside call skew. That is when people start to think that upside crashes can happen, right? We go from thinking downside is the crash probability to upside is the crash probability. Well, look where we are right now. We are starting to tick up. We are nowhere near this level of mania that we could see again. That is a sign to me, especially given the broader theme of inference AI starting to just being in early innings. This to me means that we have a lot further to go potentially in order to get to that point of extreme mania, right?